A credit score is a number that reflects your credit worthiness. It shows how likely you are to repay a loan. Most scores range from 300 to 850. The higher the score, the better your credit status. Credit scores are widely used by lenders, landlords, and even employers. Several companies calculate credit scores. The most well-known are FICO and VantageScore. They use the information from your credit reports. These reports come from three main credit bureaus: Experian, TransUnion, and Equifax. Each bureau maintains its own version of your credit history. Your credit score is not a static number. It changes as your financial behavior changes. Paying bills on time can boost your score. Missing payments can lower it. Thus, understanding how credit scores work is vital for financial health. In essence, your credit score is a snapshot of your credit habits. It helps others judge your financial reliability. Knowing your score can help you make better financial decisions. Now let's look at why having a good credit score matters. A good credit score opens many doors. It can help you get loans with low interest rates. This is crucial when buying a house or a car. Lower interest rates mean lower monthly payments. Over time, this can save you a lot of money. Landlords also look at credit scores. A high score can help you secure a rental property. It shows that you are reliable and likely to pay rent on time. Some employers check credit scores during the hiring process. A good score can improve your chances of getting a job. Credit scores also affect your ability to get credit cards. With a high score, you may qualify for cards with better benefits. These can include cashback, travel rewards, and lower fees. High credit scores can also lead to higher credit limits. Moreover, insurance companies may use credit scores to set premiums. A good score can lead to lower insurance costs. In short, a good credit score can make many aspects of life easier and more affordable. Let's dive into what affects your credit score. Credit scores are categorized into ranges to gauge your credit worthiness. A score of 300 to 579 is considered poor. People in this range may struggle to get approved for credit. A score between 580 and 669 is seen as fair. Borrowers may get approved, but face higher rates. Scores from 670 to 739 are considered good. People in this range are seen as reliable borrowers. Scores between 740 and 799 are very good. Borrowers with these scores get favorable terms. Scores of 800 and above are excellent. These are the top-tier borrowers. Understanding your score helps set financial goals and guide decisions. Several factors influence your credit score. The most significant factor is your payment history. This accounts for about 35% of your score. Paying bills on time is crucial. Late payments can hurt your score quickly. Credit utilization is another key factor. This is the amount of credit you are using compared to your total credit limit. It accounts for about 30% of your score. Keeping your credit utilization low is beneficial. Aim to use less than 30% of your available credit. The length of your credit history also matters. This makes up about 15% of your score. A longer credit history is better. It shows that you have managed credit for a long time. However, everyone has to start somewhere, and your score will grow over time. Other factors include new credit and credit mix. New credit accounts for 10% of your score. Opening many new accounts in a short time can lower your score. Credit mix, also 10%, refers to the variety of credit types you have. A mix of credit cards, mortgages, and loans is seen as positive. Section 5. The role of payment history. Your payment history is the most important factor in your credit score. It shows how you've managed your payments over time. Lenders want to see a track record of on-time payments. This indicates that you are a reliable borrower. Late payments can have a significant impact. Even one missed payment can lower your score. The longer the payment is past due, the worse it is for your score. Defaults, foreclosures, and bankruptcies are even more damaging. They can stay on your credit report for up to 7 years. It's not just credit card payments that matter. All types of credit are included. This means mortgages, car loans, and even utility bills. Always paying on time is the best way to keep your score high. Setting up automatic payments can help you stay on track. Consistent on-time payments build your credit history positively. Over time, they can significantly boost your score. If you have missed payments in the past, focus on making all future payments on time. This will gradually improve your score. Section 6. How credit utilization impacts your score. Credit utilization is the second most important factor in your credit score. It measures how much of your available credit you are using. A lower utilization rate is better for your score. This shows that you are not overly reliant on credit. For example, if you have a credit limit of $10,000 and are using $3,000, your credit utilization rate is 30%. Aim to keep this rate below 30%. Below 10% is even better. High utilization rates can signal financial distress to lenders. Paying down your balances can lower your utilization rate. This will improve your score. It's also a good idea to spread your spending across multiple credit cards. This prevents any single card from having a high utilization rate. Regularly monitoring your credit utilization can help you manage your score. Many credit card issuers provide tools to track your utilization. Keeping an eye on this metric can help you make informed financial decisions. Section 7. Building a good credit score. Practical tips. Building a good credit score takes time and effort. Start by establishing credit. You can do this with a secured credit card or a credit builder loan. These are great options for beginners. Use them responsibly to build your credit history. Always pay your bills on time. As we discussed, payment history is crucial. Set up reminders or automatic payments to ensure you never miss a due date. Even one late payment can hurt your score, so consistency is key. Keep your credit utilization low. Aim to use less than 30% of your available credit. This shows that you are managing your credit well. Paying down your balances can help achieve this. Avoid maxing out your credit cards. Another tip is to keep old accounts open. The length of your credit history affects your score. Closing old accounts can shorten this history. Instead, keep them open and use them occasionally. This helps maintain a longer credit history. Section 8. Maintaining a good credit score. Once you have a good credit score, it's important to maintain it. Continue to pay all your bills on time. This is the most important step. Consistency in payments will keep your score high. It shows that you are a reliable borrower. Keep an eye on your credit utilization. Even if you have a good score, high utilization can bring it down. Regularly check your balances and aim to keep utilization below 30%. If possible, spread your spending across multiple cards. Avoid opening too many new accounts at once. Each application results in a hard inquiry on your credit report. Too many inquiries can lower your score. Only apply for new credit when necessary. This helps maintain your score. It's also important to monitor your credit reports. Check them for errors and unauthorized activity. You can get a free report annually from each of the 3 credit bureaus. Correcting mistakes can prevent your score from dropping. Section 9. Common mistakes to avoid. Even small mistakes can have a big impact on your credit score. Avoid missing payments at all costs. Late payments can quickly lower your score. Set up reminders or automatic payments to stay on track. Don't max out your credit cards. High credit utilization can hurt your score. Aim to use less than 30% of your available credit. Pay down balances as needed to keep utilization low. This shows good credit management. Avoid opening too many new credit accounts at once. Each new account results in a hard inquiry on your credit report. Too many inquiries can lower your score. Only open new accounts when necessary. Lastly, don't close old accounts. The length of your credit history affects your score. Keeping old accounts open helps maintain a longer history. Use them occasionally to keep them active. This can boost your score over time. Section 10. Monitoring your credit score. Regularly monitoring your credit score is essential. This helps you stay on top of your financial health. Many banks and credit card companies offer free credit score tracking. Take advantage of these tools to keep an eye on your score. You can also get a free credit report annually from each of the 3 major bureaus. Reviewing these reports can help you spot errors. Errors can negatively impact your score. Correcting them can improve your score. Monitoring your score also helps you detect fraud. Unauthorized activity on your credit report can lower your score. It's important to catch and report these issues early. This protects your credit and your financial well-being. By keeping an eye on your credit score, you can make informed financial decisions. You'll know when you need to take action to improve your score. Regular monitoring is a key part of maintaining good credit health. Section 11. Conclusion and encouragement. Building and maintaining a good credit score is important. It affects many aspects of your financial life. A high score can help you get loans, credit cards, and even jobs. It shows that you are a trustworthy borrower. Start by understanding what affects your score. Pay your bills on time and keep your credit utilization low. Avoid common mistakes like missing payments and maxing out credit cards. Regularly monitor your score to stay on track. Remember, building a good credit score takes time. Be patient and consistent. Small, positive actions add up over time. With effort and discipline, you can achieve and maintain a high credit score. Stay motivated and keep working towards your financial goals. A good credit score is within reach. By following these tips and tricks, you can master your credit score. Take control of your financial future and enjoy the benefits of good credit.